Let's be honest, if you spent 2025 feeling like the markets were a complete and total puzzle, you are definitely not alone. And now, as we head into 2026, the question on everyone's mind is, what's next? Are we staring down the barrel of a massive crash, or are we about to see a rally for the history books? The signals are pointing in completely opposite directions. So in this explainer, we're going to break down the clashing forces that are set to define this year. Last year really felt like a giant game of financial chicken, you know? On one side, you had the bears, absolutely convinced a recession was right around the corner. And on the other side, you had the bulls, just snapping up AI stocks like there was no tomorrow. This incredible tug-of-war didn't just define last year, it is the battleground for where we're all headed in 2026. All right, so here's our game plan. First, we're going to lay out the central puzzle facing every investor right now. Then, we'll dive into the bear case, all the reasons for caution. After that, we'll look at the powerful bull case for optimism. Then we're going to explore a third, often overlooked scenario. And finally, we'll leave you with the big question, so you can decide for yourself. Okay, let's kick things off with part one, the 2026 market puzzle. Because even though the headline numbers look pretty good, there's this feeling that a lot of investors have, that something just feels off. Let's dig into why. I mean, the questions are just coming from every direction. Are we getting a soft landing, a hard landing, or this weird no landing scenario? Is the Fed really going to cut rates? Is this whole AI boom a bubble that's just waiting to pop? You know, with so many conflicting signals, the range of what could happen feels wider than it's been in a long, long time. It's creating one of the most unpredictable environments I can remember. So that brings us to part two, the bear case. Let's start with the pessimistic view, because look, there are some very real storm clouds on the horizon that we absolutely have to pay attention to. The first giant red flag for the bears, AI valuations. I mean, just look at these price-to-earnings ratios. This is how we measure how expensive a stock is compared to its actual profits. NVIDIA is trading around 47 times its annual earnings. Okay, but Palantir, a staggering 400 times. And Datadog is over 430. At levels like these, you're not buying what the company earns today. You are pre-ordering hope for, like, the very distant future. And hey, this isn't just an AI story. These wild valuations are pulling the entire market up with them. The S&P 500 is now trading at nearly 31 times earnings. That is almost double its long-term historical average of 16. So valuations just decide to return to normal. It's not just tech stocks that are going to get hit. The whole market could be in for a really painful correction. The second huge concern for the bears is market concentration. You see, the S&P 500 is supposed to represent 500 different companies, right? But it's become incredibly top-heavy. Just 7 of them, the so-called Magnificent Seven, now make up over a third of the entire index's value. But get this, their influence is even bigger than their size. While they make up 35% of the index, these 7 stocks have driven over 55% of its total returns. It's kind of like that group project in school where, 2 people do all the work, but the whole group gets an A. And that creates a massive risk, right? Because if those few leaders stumble, they could bring the entire market down with them. And this creates a really powerful feedback loop that's just pouring fuel on the fire. Here's how it works. Big tech stocks go up, so their weight in index funds automatically gets bigger. Then, as all of our 401k money flows into passive ETFs, it forces those funds to buy even more of those same stocks, which pushes their prices even higher. It's this self-reinforcing cycle that works beautifully on the way up, but it can be absolutely brutal on the way down. But, and this is the really uncomfortable truth for the bears, you can be right about valuations, you can be right about concentration, you can be right that a rally is totally overextended, and you can still lose a fortune. As the famous economist John Maynard Keynes said, markets can remain irrational longer than you can remain solvent. And in investing, being right too early, well, that's pretty much the same as being wrong. And that leads us perfectly into part 3, the bull case. Because despite all those very real risks, there are 2 incredibly powerful tailwinds pushing stocks higher. So, tailwind number 1 is monetary policy. The Federal Reserve has basically told us they're in a rate-cutting cycle, and lower interest rates mean cheaper capital, and cheaper capital makes investors way more willing to pay higher prices for stocks. It just loosens everything up and fuels the appetite for risk, which can push markets higher even if the economy underneath feels a little shaky. But that's only half the story. The second tailwind is fiscal policy. So while the Fed is playing with interest rates, the US government is spending massive, and I mean massive amounts of money. And this isn't just some theory. This is actual cash being injected directly into the system. It supports consumer demand, it props up company revenues, and it keeps the whole economic engine running hot. The scale of this spending is just immense. The US is running an annual deficit of over $1 trillion. That's not just some abstract number on a spreadsheet. That is a powerful economic stimulant being shot directly into the system. And this steady flow of cash provides a huge supportive safety net for corporate profits and, by extension, for stock prices. Okay, so this brings us to part 4, the gray area. We've got an unstoppable force, all this liquidity and spending, meeting an immovable object, these extreme valuations. So what happens when they collide? Well, you get an outcome that almost nobody is positioned for. So what is it? A massive melt-up, just fueled by cheap money and government spending? Or a painful crash, driven by these absurd valuations and this crazy market concentration? What if the answer is neither? What if instead of a clear direction, up or down, the most likely outcome for 2026 is something stuck right in the middle? A long, choppy, sideways market that basically just goes nowhere. And let me tell you, this type of market is often the absolute hardest for investors to survive. It's an environment where rallies just fizzle out right when you start to feel good. The dips feel terrifying, but they never quite go low enough to be a real buying opportunity. Capital just rotates endlessly from one thing to another. It is a market where impatience just destroys portfolios, and it feels like every single decision you make is the wrong one. So that brings us to our conclusion. We've laid out the case for the bears, the powerful tailwinds pushing the bulls forward, and that frustrating gray area stuck in between. The question now is, which of these forces is actually going to win out? And that's the crucial question I want to leave you with. Where do you land? Do you think the cracks finally start to show and the bear case plays out? Do you believe those twin tailwinds of stimulus are just too powerful and will keep pushing us higher? Or are you bracing for that long, frustrating sideways grind? There is no easy answer here, but knowing the battlefield, well, that's the first step to navigating it.